Sean Fenton from Sage Capital is joining me here with his view. Sean, welcome and Happy New Year to you.
Thank you, yourself.
Look, it's quiet out there, let's be honest. There's still a lot of professional investors yet to come back in full force. Chinese markets closed, but we're watching this rally happen. Are you believing it? Are you not?
It's an interesting rally. Yeah, sometimes start of the year you get some technical factors, you get risk parity funds rebalancing, you get institutions, so low liquidity periods, and the market's certainly off to a roaring start for 2023. Can it keep going? And that's the real question. I think there's a fair bit of optimism last year that we'd seen the peak of inflation, and you have seen a lot of that real pressure in inflation in terms of shipping costs and manufactured goods and energy prices all coming back down and giving some relief and giving some optimism that the Fed's done enough and they're going to be cutting through next year, and this can sustain a bit of a rally that it's going to be a very shallow sort of slowdown and it's all back on again. But as you mentioned, energy prices are rising again, and I think that's a real challenge for markets through 2023. Last year was a really interesting market. You had Russia invading Ukraine and sanctions against Russian oil, and the expectation that energy costs would go through the roof. Europe stockpiling gas, but all we saw through the second half of the year was energy prices or oil prices fall as that Russian product came out through China and India. You had China go into lockdown. And you had the US releasing strategic petroleum reserves. So Joe Biden sold 40% of the strategic petroleum reserve, and that got the oil price down. Where we are now, those sales are finished. China's reopening. The EU's putting some sanctions on refined product out of Russia starting next month, and that's starting to tighten up the oil markets again. Optimism that maybe the slowdown's not so bad. Refining margins are increasing. So it's a little bit self-limiting. There's the optimism there that things are getting better, but as they do and the energy prices start to recover, then suddenly inflation's back, and we haven't really had a recession or a slowdown. Labour markets are really tight, so any hint of inflation again, and central banks are going to be back tightening. So yeah, it's off to a good start, but we just see volatility ahead of us and some real limitations on a sustained rally.
Healthy skepticism, let's call it that, because you've got China reopening, which could essentially be inflationary. Central banks have repeatedly told us, particularly the Fed, that they are not going to blink until they see that 2% target, in reality. So, when you think about this earnings season as well, not just in the US with the quarterlies, but the earnings season that's knocking on our door here in Australia, could this potentially be a trigger for an end to some of this enthusiasm in the market when we see, what the impact of this environment has been in black and white?
Potentially. So I think they'll certainly be looking for signs of it. I think so far the last half of last year there's tightening. There's certainly some pullback in some areas, like really rate sensitive areas like US housing pulled back quite sharply. And you've seen the consumer pull back a little bit, but a lot of that's just been transition in where spending's been from goods and online shopping to eating out in restaurants and travel and spending. So the economy as a whole still seems robust. Everyone's got a job. There's some cost of living pressures, but it's not falling in a hole. So we don't expect really bad news out of the reporting season in Australia or the US, but maybe just the first signs that things are slowing down. So you've seen obviously big tech firms in the US start to shed some jobs, which is an indication that maybe they're seeing revenue growth a bit softer. And at the margin, you're starting to see the consumer soften, but it's not, it's not looking cataclysmic at this stage. So, and these things take time, but the markets will still be very sensitive to that, and particularly, I think, outlook statements, the confidence of management, what they're seeing at the coalface. Yeah,
we want to get those outlook statements from corporates this time around, no exceptions. So, can I read into this that you see potentially a bottoming of markets sort of into the second half, mid-year?
We see potentially anything. Like the Australian market, it's almost at record highs, so it's way off the bottom.
It's extraordinary, really, when you think about it.
Quite amazing, and the big drivers, resources, iron ore, and banks with net interest margin expansion have all been very strong. The US is still down a lot, but that's really just valuation effects. Bonds have gone from extreme lows with COVID stimulus back to sort of more normal levels, even sort of a little bit pre-GFC levels. So that valuation impact's flown through. I don't know if that reverses, but we haven't seen, I think, the big earnings downgrades priced into market. So that risk's still there. But inflation, there are those forces pulling it in different directions. As you say, labour markets are tight. The Fed's worried about core services inflation and wages growth and feeding through. But if you get enough relief on inflation, then certainly if inflation goes away, then we're off to the races, and certainly the tightening pulls back a bit, and we're into another bull market. But that can easily flip either way, as we said. So we're trying to be balanced and very close eye on things like inflationary pressures and what the Fed's saying.
Well, that's what I was just thinking, because with all of what you've said, I mean, it sounds impossible. You've just got to hedge your bets in ways. So how are you doing that? Do you keep some in cash, or are you favoring local equities over international equities, sectors? It's how then, with all these unknowns, are you investing?
Good question. So this we always try and strip out some of these big sort of secular shifts that can drive markets. We run a long short fund. We can have a whole range of different positions across Australian equities. So we run very diversified portfolios that take a lot of relative positions in stocks. So we can take out some of the market exposure, some of the big sectoral moves that drive across markets, and just focus on what different companies are doing, who's relatively more or less expensive, where earnings are relatively going. So look for parts of the market where there's some structural protection around earnings, things that have got barriers to entry, or good market structures where there's less competition, versus those that might be suffering a little bit more from the impacts of tightening and downside risk and the like. So
it sounds like hard work.
It's constantly hard work.
Yeah. Any shortage of opportunities, though?
There's never a shortage of opportunities. So there's always things happening in the world and the market, and things are always changing. So that environment that we're moving into, with a bit of volatility and uncertainty, I think that just creates more opportunities, and you get more disconnections of prices from reality, and they can correct back sharply and those sort of things.